Hey everybody, it's Lauren and it is Tuesday. Happy Tuesday, everybody. So I wanted to talk today about all this media attention to the Fed fund rate. And I get a bunch of phone calls from real estate agents and from clients and kind of people freaking out about how, oh, the Fed's going to increase the rate. And the perception that is a misperception is that that is increasing the mortgage rates, which it isn't. So I wanted to kind of clear up a little bit and maybe make it, not, I don't know everything, but from my understanding, so when the Fed increases the Fed fund rate, what that really is the rate at which banks borrow money, which then, obviously makes the cost of credit higher. So you'll notice that prime has gone up, and that's, excuse me, that's the rate for your credit cards. Speaking of credit cards, the average, I just Googled it, the average interest rate for a credit card is 21%. What? People are freaking out about mortgage rates, but that's another topic. So what happens is the Fed increases those rates, and ideally, they're trying to tamp down inflation, and they do that by discouraging people from buying more stuff, as if we need more stuff. But so people are not spending as much money because that's going to keep the economy back in, kind of in balance. The problem is that everything's really expensive right now, right? Like eggs and gas and milk and whatever you get at the grocery store, your kind of everyday cost of living has gone up. And a lot of people are using credit cards to pay for that stuff in hopes that it will come down in the future. But what's happening is they're really spending a huge amount of money on interest. And that might be better served with either a cash out refi or a HELOC, which is a home equity line of credit. And so the big news of the day is we now get to do home equity lines of credit for our clients. And that is so cool. So it's not a mortgage, it is a line of credit, so that if you needed to, buy something, I wouldn't use it for groceries, but something, that home improvement, or you have some extra bills that just don't seem to be getting paid down. I can't really tell you the rate right this moment, but I can tell you it's a whole bunch less than your credit card rate. So with all of the equity that we've all seen in housing recently in the last 2 years, everybody's kind of sitting on little piles of money in their house. A home equity line of credit would allow you to use some of that. And it's not a long-term fix. It's a shorter term fix. You want to definitely pay it down, but it is a way to kind of pay for things that without using your credit cards, because credit card debt is not, be really careful. Those interest rates get really, really high, 21% average. Even like, good credit card rates are what, 12, 14, 15. And we're seeing HELOC rates in the, 7.5%, 8.5% range. So if you think about that, the amount of money you're not spending on interest is really valuable. So if you have any questions about HELOCs, cash out refis, using the equity in your home to kind of help pay for things, maybe it's a college education, maybe it's medical bills, maybe it's home improvements, maybe it's just high credit card balances that you just can't seem to knock down and remove. So we love to help people try to maximize their wealth using their mortgage. So whether it's, again, a HELOC or a cash out refi, we want to answer those questions for you. So super excited about the ability to offer HELOCs, and just can't wait to watch people's lives change just a little bit, because maybe we could help make it easier on a month-to-month basis. So have a wonderful Tuesday, and we'll be back with some credit tips next time. I could probably do about 20 videos just on credit.